Welcome to the B.F. Anderson Technical Report for September 28th. We're going to do this a little early this week with the market volatility. I thought we would go ahead and get everybody updated. However, this is a very interesting report. You know, one of the highest correlations to long-term stock markets is demographics. So what this graph is showing is the spending patterns for different age groups. The highest spending patterns are between the ages of 35 and 54. So if you go back and just kind of look at this and say, where are the millennials? Where's the largest portion of the population? Because the millennials, as of 2016, have now passed up the baby boomers. So you can kind of see what the cycle is like. This was 1945 to 1964. The market peaked in 64. It took off in 1945 because of the number of baby boomers that were being birthed. Then we went into a bear market starting in 1966 and basically did not turn back up again until around 1983. And you can see the correlation here. Now, what's happening now is the millennials have now passed up the baby boomers as the largest generation, the largest labor force, etc. And so if you go back and just kind of look at this from a graph perspective, you can see here that when the baby boomers turned 35, which was in 1981, there was somewhat of a lag, but then the stock market basically took off. Now, we had the crash of 87 in here, but so between the years of 1988 and 2000, the S&P climbed 434.35%. Then we went into a multi-year bear market. Then, as you can see here, as the baby boomers, this was 2000 was when the baby boomers turned 54. Now, the millennials turned 35. Now, remember, 35 to 54 are the big spending years. Also, what's going on there is in those age groups, 35 to 54, those people are producing more than they're consuming. Therefore, there's capital left over for savings and investing. So you can see here the millennials made 35 in 2016. Market has pretty much taken off. Kind of had a little bit of a crash of 87 type situation here, somewhat of a lag. So the millennials do not reach 54 until 2035. So the argument here would be is that the market, just like it did back in past cycles, the market could really continue to be in an uptrend until 2035, which is 14 years from now. Now, let's get into what's going on right now in the short term. You can see here on the NASDAQ, we have broken down below the 50-day. We're getting somewhat of a pullback here. Now, you can see here on the long-term graph, we continue to be constructive. So, you don't want to get too bearish, but at the same time, continue to use caution. Now, as you can see here on the mid caps, somewhat of a failed breakout. Broke out and then it's pulled right back into that base again. Somewhat of a failed breakout. Here's the New York Composite, same thing. Tried to break out, really didn't even break out, pulling right back into its base. On the small caps, again, we got a failed breakout. Not as bad as the mid caps, but again, pulling back to the top of the base. On the S&P 500, you can see here now we're starting to break down. The 10-day moving average is actually crossing below the 50-day. Things are looking kind of iffy here. Be very cautious. But like I say, on the long-term basis, we're still in a bull market because both of the NASDAQ and the S&P are above that 35-week moving average. Now, on the aggression index, we're seeing somewhat of a downturn as technology is somewhat getting hit here. On the economic indicators, what's really, I believe, causing this is interest rates have all of a sudden started to spike. We're now up to 1.529. Now, remember, back in the summer, well, really March, April, we got up to about 1.7. Also, oil prices starting to move up, kind of whiffs of inflation. The financial stocks have moved up along with interest rates. I believe the higher interest rates are what are really causing the problem here. New lows have picked up. Like we said, we don't want to see an extended period of time above 40, which we're somewhat getting. Again, this just continues to emphasize the importance of caution. Now, on the inverted yield curve, no inversion, actually seeing some improvement here. What that means is the 10-year Treasury is moving up faster than the 3-month Treasury, which is keeping us from inverting. Here is the sentiment readings for the retail side. We continue to be in a much better situation here. On the institutional side, we continue to be in greed. Russell 2000, you can see we're continuing to move sideways. We tested, we tried to break out, failed. However, we are making a higher low here, which is constructive. Excuse the dogs. I'm sorry. Junk bonds starting to improve here. We're seeing a big improvement in the junk bond market, which means people are basically moving to bonds in a big way and looking for higher yield. Volatility index, we are getting a spike. As you can see here, rate of change was pretty high. Now, as we get into the top 5, remember here, what we're just trying to do is a technical exercise on learning how to read charts. As you can see here with Antero Resources, which is an energy exploration company, uptrend, broke out, kind of pulling back a little bit. Energy stocks are looking strong. As you can also see here bear with me. Okay, here we have Antero in here twice. Avis Car Rental, it actually blowing out of here. For some reason, the car group is rental cars are hot. Continental Resources, another energy stock, continuing to break out here. Devon Energy, same thing. So we're seeing a tremendous move in the energy sector. Technology is definitely pulling back. So continue to use caution. If you have any questions, please give me a call. Thank you very much.